Bitcoin, objective perspective in a chaotic world. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, welcome Drew for his debut Insights appearance after writing today's very thoughtful article on Bitcoin and how he thinks about its current setup through the lens of technical and sentiment analysis. How are you going today, Drew?
Good, Chris. Thanks for having me.
Thanks for coming on. Now you're down in the Melbourne office, so people will be familiar with you from down there. Maybe not so much up here in Brisbane, but we'll get to know you because I know you're very keen to be involved with these articles and coming on Insights to discuss things. So we appreciate you coming on today. And it was a great article you wrote, really talking about zooming out a bit and looking at that bigger picture when it comes to Bitcoin, particularly in these chaotic times. So can you start us off today by just elaborating a bit for people how they can actually apply that? Because we all say zoom out, look at the big picture, but when you're caught in the day to day, it's often tempting to just be looking in at the minutia and really stuffing yourself up often by focusing in too narrowly.
Absolutely. I think so. I guess there's a few aspects to it. If you're looking at the day to day, I think these days we get caught up with so much information. There's just a massive information overload. So limiting what you actually take in. So having maybe two or three reliable, regular information sources and not just scrolling on platforms like X, listening to anyone and everyone, your favorite crypto influencers, will inevitably tell you to buy and sell at the worst times. So just curating your information sources quite brutally, I think is important. And then zooming out. So with crypto, there's never an uneventful day. There's always something that's either the next best thing or the end of the world. So I think zooming out and just taking a bigger picture with more objective data, looking at things like basic technical analysis, like we've looked at in the article, and then analyzing sentiment in the market can be quite useful as well, rather than basing it on every single event that takes place in the markets on a day-to-day basis. So it's really about curating your input and then just working on a personal level. I think people can make sure that on a personal level they're just not easily influenced or emotionally reactive. Doing that personal work, I think, helps you become a better investor as well. But that's each person's individual journey, I suppose.
And it's such a valid point around that emotional aspect of it because it's hard not to get sucked into that. And you do need to put the work in to actually acknowledge it, I suppose, to acknowledge that you are going to be driven emotionally when you experience big moves in the market that are going to draw you away from something a bit more grounded. And that's what I thought was really valuable in your article because you talk specifically about technical analysis and sentiment. But let's just start on that technical side. There was things like the 50% retracement rule you spoke of. You mentioned a few others as well, technical things that you look at. What's your go-to that is your grounding? What's your go-to technical analysis that you go, okay, this is what tells me I don't need to get caught up in the emotion of it?
Honestly, I think with technical analysis, the less indicators you have, the better it is.
Mm.
And from what I've seen, it's keeping it as simple, almost stupidly simple. That works the best. So the 50% rule, there's nothing fancy about it. You take the bottom price, the top price, and you look at the halfway point. And it's amazing. You can apply that to any markets, anything with a chart, really, over the last couple of 100 years. And you will notice that on any time frame, whether you're looking at the hourly chart, the 4 hour, the weekly, the monthly, or the 6 monthly chart, on a long time frame after a sustained move up, the asset tends to come back to its 50% point if it is in a strong position. Now, it doesn't have to do that. It can always stay elevated above it, which shows further strength. But if you start seeing closes on whatever time frame you're looking at below the 50%, that's an objective sign that that sustained run is now struggling to maintain momentum. So if you're analyzing a daily chart, you can look at a sustained daily move up, look at the 50%. If you start seeing daily closes underneath that 50% level, it's time to start maybe considering paying attention to what's happening in the market. maybe considering taking some off the table if you're in profit. And that helps you keep things objective. So, if you're looking at the monthly chart on Bitcoin and the 50% sitting at 44.5 roughly, thousand US dollars per Bitcoin, you can have the end of the world happening out there. But if Bitcoin is sitting above $44,500 US on a monthly close, it's objectively bullish, it's objectively strong. And if you've got closes that are well above that, it's even stronger. So, given all the things that have happened in the last 5 or 6 months globally, with Bitcoin really just being in a sideways consolidation range when you move out, but each one of those dips down feeling like it's the end of the world, you can sit back objectively and say, well, I can tell you based on the data that it's not. So I think the most successful investors and traders are the ones that are able to separate themselves from their feelings and make objective decisions on the long term.
I really love the simplicity of that approach where you're using something like 50%. Like anyone can calculate that. You don't need to have specific indicators or anything, really. You can look at a chart and just identify that. And this idea that if it's consistently staying above that, that is showing strength. I mean, we've seen that recently. It has been showing strength against a whole raft of things that could be reasons for it to fall. Like there's everything going on at the moment. You also mentioned, though, the sentiment analysis side of it. Is that the sort of flavor that you add to that very simple analysis to help support the idea? Is that how you approach it? And can you maybe give us a little bit of detail around what you mean by that sentiment analysis as well?
Definitely. I think sentiment analysis on its own is useful, but it's really useful when you use it in conjunction with technical analysis. So if you're looking at either market tops or market bottoms, combining a divergence between sentiment and the chart, the price chart, can often help you work out whether the market is at a major top or major bottom. You can also use it in consolidation periods. But if you look back to what happened in October of 2022, Bitcoin closed a certain price. Then we had a higher close on the Bitcoin chart, but the sentiment got worse. Now, market participants had just gone through a huge bear market, everything from the FTX collapse to Celsius, Luna, and the list goes on. So that sort of sentiment has momentum behind it. And you might see that the price is done correcting and we are now starting to get ready to move up. But the momentum behind that sentiment takes some time to dissipate out of the market. So when you see sentiment get worse on a higher price close, you can tell that we're potentially looking at putting in a low. Now, there's no guarantees, but that's a pretty strong indicator. You can also use that at market tops when you're getting a sign of technical weakness in the chart. You're getting a lower close on a higher time frame, or you're seeing a swing bottom broken on a higher time frame, where you're seeing, or maybe even a 50% broken on a higher time frame. But you're seeing sentiment become better and more bullish, or stay the same. That's an indicator that maybe the market's getting ready to turn down. In the most recent example, the way we use sentiment is we see the price going more or less sideways within a range, and sentiment get progressively worse over the 5 months, where it's gone from 100K next week, I'm mortgaging the house to put it all in Bitcoin, all the way to the bull market's over. This is done. We're going down to 35K, things like that. So seeing sentiment drop that drastically over 5 months when the chart is an objective technical strength shows you that we're basically not at a market top, that the sentiment's reset, and we're probably ready to continue upwards to get that sentiment back up again.
And that's so true, those examples, because we have seen both extremes. You can see them play out in X is a great example for this, where you can see people making really strong arguments for why it's going higher, but the moment that the price starts to fall, there's fear and panic everywhere, and you've got all these predictions of it going really down a very long way. It's really just emotionally driven. You can see that unfolding. But an argument, this is really interesting, and I like your opinion on this, because an argument that seems to keep popping up is that, particularly in mainstream media, actually, when they talk about Bitcoin, is that it's not serving its role as a store of value because of how volatile it has been through this period of time. There's definitely two trains of thought on this. One is that no, that's just how Bitcoin behaves. That doesn't undermine its use as a store of value. But there's another side that says, well, you do see such high volatility. That's not really the essence of what something should be if it's going to be a store of value, particularly if you compare it to something like gold. Now, you're working with Ainslie, you understand all the time the value, the gold proposition, the value of gold as a store of value. How do you see Bitcoin fitting in as a store of value against that backdrop as well? Is that part of your thinking around this analysis of it overall?
Absolutely. I think what makes something a store of value is multiple features. I think looking at the five properties of what money should be is probably a good metric for that. Now, the five properties of money are durability, so it shouldn't disintegrate. Portability, you should be able to move it from A to B. It should be homogeneous, so uniform. This Bitcoin is the same as that Bitcoin. This piece of gold is the same as that piece of gold. You want to have limited supply, so it's got to be scarce enough to have value. And for me, the most important point is the fifth one, which is it should take energy to produce it. The reason that's important is because when we work or provide, service or create something, we are giving our human energy. And what we get in exchange is money. Now, that money is supposed to hold the energy that we have given so that we can then expend that energy for other things that have taken up energy. That allows the transfer of energy from one place to another in an economical sense. Now, in terms of a store of value, I think that actually leads into the difference between money and currency. So fiat currency versus what actually money should be. When you look at fiat currency, it's actually missing a few of those very important properties. It does not take energy to produce. You can type numbers onto a screen. You're not even really printing pieces of paper anymore, which means it's not holding any energy. And the second aspect is that there's no limited supply. So there is a big hole in that bucket. There's inflation that constantly is eroding the value of the fiat currency that we get paid in. Now, that leads into a much longer conversation about moving from currency into money, moving from fiat into hard assets. But to bring it back to the question of a store of value, Bitcoin and gold both have the five properties of money, which means, in my view, they both classify as a store of value. Now, Bitcoin has the five properties hardwired into it. It's coded into it perfectly. So arguably, it's a better form than gold. Gold does have the five properties, but there are limitations to the portability, the divisibility to an extent. Well, that's basically the two that Bitcoin really, has an edge over. Gold has a history of 5,000 years or more. Bitcoin's been around for about 15 years. So the volatility is in Bitcoin finding its feet, proving itself, coming of age. It's a much smaller market cap. So by default, smaller markets will always have more volatility. The volatility for me does not necessarily exclude it from being classified as a store of value. It's more the other points that I think are important. For me, the volatility is more of a feature rather than a bug. Because of the extreme inflation and devaluation of the fiat currency that's happened since Bitcoin's inception, that was after the GFC in 2009, there is a lot of catch up to be done. And this gives people the opportunity to get into hard money and have that volatility on the way up. And of course, that means it's going to have it on the way down as well. But when you zoom out on a long enough time frame, it outperforms literally every other asset class. Eventually, that volatility will reduce.
I really love that answer, because often when people are debating this, they're really only using that superficial analysis of what is going on, and they're really missing that key point that you made, the difference between currency, between sort of fiat or what we consider money generally, and real hard assets that are actually money, because that is so important. Because when you've got they never understand that the dollar itself is very volatile when you place it against other assets that maintain their value over time. So I think that was an excellent answer. Really, really gets to the bottom of that very challenging debate that's out there. One last area I want to touch on before we wrap up today. We've mentioned, I mean, you talk about in the article, market sentiment is leaning towards fear at the moment. We've still had people being very concerned about what's going on. The technical analysis is quite bullish, as you pointed out. We're still sitting above that 50%. If you wrapping it all up, what should people be looking for over the next weeks and months to gauge whether this trend will continue or reverse? So if someone's watching this and goes, well, is it the end of the trend? Is it the beginning? I mean, you probably think there's still more up to come, but what are they looking for to prove or disprove that thesis?
Definitely. Look, I think the 50% is a huge factor. So if we start seeing long-term closes below that 44.5 number, roughly, I think it's 44,800. On a weekly basis, look, if we spike below it, I'm not too concerned. If we see one weekly close below it, I'm starting to pay attention. If we see multiple weekly closes below it, then I'm getting quite concerned at that point and looking at that almost as a sell signal to start taking some off the table to de-risk on that next bounce. Now, apart from that, there are other indicators you can use. You can look at going back to, so the 50% is not my own tool. It's something developed by W.D. Gann about 100 years ago. He's got a few others that I use as well, which is a Gann swing chart's another one. If you start seeing long-term swings broken on the bottom end, that's something that our listeners can research online. There are free Gann swing indicators on TradingView. A good one is the TIA Gann swing indicator. If you want to study that and look into that. And then the other thing is looking at long-term trend lines breaking as well. So if you just draw a trend line from the bottom of the bull run on the monthly chart and see how far above that we are, we're still got miles to go. So if you see closes below the 50%, a break of that long-term trend line and a break of Gann swing lows all at the same time, while sentiment isn't really changing much, that's a pretty clear sign to me. But what I find interesting is, over the last few months, we've seen people talk about, I'm going to buy heaps of Bitcoin if it goes to 40K. And they'd arbitrarily start pulling numbers out that are based more on just a feeling. Versus if Bitcoin were to start closing at 40K, that's a sell signal to me, not a buy signal.
Yeah,
it might seem really cheap because, it was just at 80K and, I was 73K and now it's at 40K. Why wouldn't I buy some then? But objectively speaking, that would signal a break in the macro bullish structure, which means it's the end of this bull run that started at the end of 2022. And what you'd likely see is an extended period of sideways in the best case, maybe some further downside, which means it's actually expensive at 40K and you can buy it cheaper, probably not too far down the track. And nothing's guaranteed. That doesn't mean that it definitely has to happen. It could go to 40K and then continue up. But statistically speaking, the odds are not in your favor of the bull run continuing if Bitcoin has monthly closes at 35 or 40K. So I think what people should look for is just simple, objective, technical truths on the macro chart. Keep an eye on that and just ignore the day-to-day chaos that we're all experiencing.
Look, such valuable advice in that. A great discussion today. Really appreciate you coming on, and we'll certainly keep having you back to discuss all of this and other areas, because you cover all this stuff, not only the crypto but also the macro and the bullion side of things. So really appreciate your work on it, and look forward to having you back. So thanks for that today, Drew.
Thanks, Chris. It's great to be on. Chat to you soon.
Thanks everyone for watching. We'll all chat again soon.